the front row. Yeah? Well, thanks so much for joining us this morning. My name is Liang, Zhao. I'm a publicist by day, but really I love to consider myself an API amplifier and hype woman all around. Going to the ground, so I think it might be mine. Okay. So I'm a bootstrap company, but I work with a lot of tech companies that are institutional backed, which is why I'm so excited about this panel today, because we have a bunch of experts who are investors, entrepreneurs, funders, which is such a diverse amount of experience. So first we have Lee, honorary male. But he is the founder of Spaceport, and he successfully scaled companies to 5 million ARR and raised a bunch of money in various capacities. And so he is our, tales from the everyday in and out for us to reference. And then we have Keung, who is a general partner at J2 Ventures. She has just many years of experience across a lot of different types of investments, including working at the SBA, family office, now venture capital, and so she's just really incredibly knowledgeable around non-dilutive capital and super passionate about providing more capital to the hands of minority and women, female-backed businesses. We have Robin Lee, who is recently the new head of the East Coast Investor Relations at Notable Capital. She's amazing. Hands down. Community organizer. I think many of us are a part of the API community Slack group that she founded. And then Ratna, who is a VP at JPMorgan. She has 8 years of banking experience split between investment banking, where she specializes in raising capital for later stage companies, public companies, and then also commercial banking. So, Ratna, you're on the hot seat, first and foremost. Can you tell us a little bit about the fundamental differences between equity and debt?
Of course, and thank you, Liang, for that. I think it's an excellent place to start, as we talk about finding your funding fit. And it's one of the questions actually we hear continually from the founders we speak with, as they get ready to raise their A or kind of rounding out their VC raise. They debate whether to access venture debt as well. And often the answer is not clear-cut, black and white. It depends on their specific circumstances and goals. In the last 4 months, you wouldn't believe I've actually spoken to 4+ people in the same in the CPG space and the internet space who are actually dealing through this like live, whether to raise another round or go to debt. And when you actually think about making the decision, there are 3 main factors when you raise capital in any form, so to speak. The first is the cost of it, and in most cases, under normal circumstances, the cost of debt is typically much lower than the implied cost of equity. But when you raise debt, the caveat is that you have to make regular payments, and there are cash outflows, which could be really challenging for a very early stage company that are on a high growth path trying to preserve cash. The corollary to that is, what is your expected use of proceeds? What are you going to do with the cash, and what's the return going to be? So, and the amount of capital needed to generate high return investments at an early stage often exceeds what you can actually raise via debt. The second thing is your risk profile, and the market you live in. So, if you have a business which has unpredictable cash flows or is seasonal or in volatile market conditions, you may prefer equity, so you're not bogged down by debt covenants or cash payments, and you have operational flexibility as you grow. And the third thing, which I think all of you know, and is probably the most important thing, is control and ownership. As soon as you raise equity, that's an immediate dilution, and some loss of control based on what structure you use. However, in turn, you get valuable investors. That is an invaluable expertise operationally that you get as an early stage founder as you're trying to scale and grow. And some venture debt, honestly, can also have dilutive instruments like warrants, that protect lenders against the downside. So if you think about it overall, when we think about growth stage founders, equity and debt is not really one or the other. Most founders we regularly talk to actually use a combination of both equity and debt always to grow and scale.
Awesome. Thank you for that. And by the way, we have a cheat sheet behind the panelists with the different types of equity financing, debt financing, realizing that the font is pretty small. So please take a picture and zoom in, post on LinkedIn, support the conference, give it visibility, but also we can send it to you after as well if you would like. And so Lee, I saw you nodding from across the way and with some of Ratna's answers. Now, can you talk about a little bit about your experience when it comes to bootstrapping, angel investing, and then how you thought about moving into the VC direction?
It's good to be here today. Hello, everyone. Thanks for coming. I have raised money from probably every type of funding source possible. So I've raised angel money, crowdsourced money, venture capital. I've secured lines of credit. I think reflecting on my journey to date, and this is my third time around to running a company and also raising money for a high growth company. This time around, the first thing that I thought to myself was, what's my personal objective here, right? Like, where do I want to be in 5 years and 10 years? What kind of company do I want to build? Because that's a really important first step to frame what kind of money you want to raise, who you want to raise from. That helps you determine what kind of market you want to serve and what kind of product you want to build. Because certain types of capital are better suited for specific types of businesses. I think about GPT, right? Not chat GPT. This is like growth rate, profitability, total addressable market, right? These three terms. Can this company grow very quickly? Do you know how to grow this company very quickly? Can it be very profitable? Right? Can you generate really great unit economics? And is the market really, really big? Are you selling a very specific niche, pair of shoes, or are you servicing AI that's going to disrupt the entire world, right? So I think if you have none of these, right, if you're focusing on a very small business, then your options are a little bit more limited. And if you're trying to build a very disruptive company, then you have more options, right? You can go to venture capital and you can raise more money. And then thinking about, okay, do I want to retain ownership? How long do I want to run this business for? If you're committed for a 10-year plus journey, then you could be aligned to a venture capital who's trying to grow that company for a very long period of time as well. So I guess first things first principles, think about what your end goal is and start from there.
I love that. And then speaking of venture capital, this question is for both you, Robin, and Christine. I'll let you two pick who's going to start. But the question is, what do venture capital investors look for in a company? And then what are some of the expectations you set once the money is in the hand of the founders? And then after that, how do founders meet those expectations of the investor?
That was like 3 questions, so we can first of all, it's so great to be here. Especially because Lee and I have actually known each other for over 10 years, and especially when you're working on company number 1 or company number 2.
He needs more money.
He does not, I have checked. but one thing, so Lee's already kind of touched on some of the things that venture capitalists are looking for, right? You've spoken about traction, product market fit, and market, but the one thing you didn't touch on that I personally think is most important, especially as an early stage investor, is the founding team, right? Because I really think that is, I spend a lot of time really just assessing the strength of the team, the chemistry within the team, right? And trying to back into what is required for this team to succeed. Because ultimately, early stage companies, we're oftentimes investing kind of knowing that the product might ship, right? Product market fit isn't always guaranteed, right? And market dynamics can change. So really, the one thing that can kind of stays constant throughout is the quality of the team and their ability to execute on that vision. And so that is actually, if I had to force rank and prioritize, that is probably the most important thing to certainly, me and my team as an investor is we really, really care about the strength of their team, their unique skill sets, complementary skill sets, and character, right? That's probably most important. Like being an entrepreneur is so hard, and so I think like even beyond just looking for maybe a disproportionate competitive advantage or expertise, like I also just look for resilience. Like I look for somebody who sort of has the perseverance to go through like the ups and downs of building a company. And if that's missing, like we certainly don't feel comfortable investing.
I guess maybe a question from me is what stage do you specifically focus on? Because I think that question also like
because we invest in different,
right? Yeah.
So at J2 Ventures, we're early stage investors. So we're typically pre-seed to seed, and especially out of our current fund, we're the first check-in.
So like that makes a big difference, because at Notable, we are not the first check-in most of the time, unless you are a repeat founder that we've had back before. We're typically seed and Series A and Series B is where our sweet spot is, so like one right after you. And like for us, we definitely don't typically do pre-product or pre-launch. And so when we are looking for metrics or KPIs, we do care a lot about, are there early signals? Can you make the right hires, right? I think initially you may not have the full team yet, right? Maybe in the pre-seed you have some founders, but most of our portfolio companies over time don't stick together as a founding team forever, right? Like nobody has that expertise to scale from 0 to 100, 100 to 200 to like 1,000 plus. And so I think from like a founding team standpoint for us, like the ability to attract talent is an ability to sell your story is probably one of the most important points on the early stage side.
And what are some of the business metrics that startups or that you're looking for as investors?
And maybe we should talk a little bit about categories too. For us, we focus primarily on infrastructure, DevOps, cybersecurity. We do some fintech and commerce. And so for what we look for, tend to be very specific. Like on the SaaS side, there's magic numbers. There's certain things that it is showing like how much does it take, how efficient is your business to scale over time. We are not looking for maybe like a suite of products in the very beginning. Most software companies have like a single product that gets you to 100 million in revenue, and then build out like a bigger suite over time. And so I don't think in the very early stage you have to worry a lot about that, but we are looking for like founder market fit, product market fit as well.
Yeah, Robin, I agree with everything you just said, and for us, like we're specialized investors as well. So J2 Ventures, we are deep tech investors. We invest in what's called dual use technology. So it's really any technology company that can serve two markets, government and commercial. And we look for companies where we could actually provide strategic value and disproportionate value on government go-to-market. And so that lens keeps us focused as investors, but also that is actually something when we're evaluating team, right? We are looking at the defensibility of their product. We're looking at, oftentimes like intellectual property, right? Intellectual property, traction on the commercial side, but we're also diligencing their ability to actually get government contracts and non-dilutive capital from the government as part of our evaluation.
Amazing. That's great. Thank you for that background. To bring it a little bit before when a founder or a team or a company would be looking for venture-backed funding, what are some of the other ways that they can get funded? Ratna, you spoke a little bit about the various forms, but additionally, Lee, I think you've also sought out crowdfunding in the past, right? As a capital source, and then also bank loans that you had also mentioned. Can you talk a little bit about, when you're initially starting out as a business, like what are some of the ways that a company can get funded?
So many different ways, but I guess for a lot of new founders and entrepreneurs, you might seek angel funding first, or like friends and family funding. Who here in the room, by the way, has invested in a company before? Raise your hand. All right, so that's your answer. Go talk to the people who raise their hands. I I think friends and family funding can be a good source to get you off the ground and to start spending full time on your product. Again, it comes back to what kind of company you want to build. For me, it's always been high tech, high growth companies. So to that extent, I've really focused on venture capitalists to start, right? So early stage VCs, early stage angel investors or super angels that can write really large checks. And yeah, ultimately it really depends on what type of industry you're in. Actually, can we just do a quick, another raise of hands for, who's in like the retail industry today? Or maybe we could just shout out like what kind of industries you're in. Services.
Medtech.
Medtech.
Robots.
Robots, cool.
Package protection.
Package protection, awesome.
Wellness.
Yeah, wellness, all right.
Shoes.
Shoes, very, very diverse industries, right? So, I think in some of these industries, you might have to raise a lot of money up front to pay for inventory, for instance, right? But in that case, a loan might be a good option, right? If you can secure a loan, you pay for inventory, and you already have your distribution set up, then you can scale your business that way. If you're building a robots company, you probably need a lot of capital up front in order to perform R&D, but the market for that application, right? You might be automating some task which is costing an employer hundreds of thousands of dollars a year. You might be able to generate a lot of revenue in the future. Then you might be able to interest angel investors or VCs that are looking for a longer return and are willing to take that risk up front, place a lot of bets in order to support you. So I think it's possible to go after each one of these avenues from day one, depending on the type of business that you're in.
Christine, can you talk a little bit about non-dilutive capital?
Yes. So just for folks' awareness, like non-dilutive capital is basically it's a type of capital that doesn't require the business owner to give up equity in their company. And there's actually a lot of non-dilutive capital from the U.S. government. First of all, how many of you know what the SBA is? Oh, great. Okay, cool. The U.S. Small Business Administration. It's this like kind of sleepy agency that really became, I think it's okay, so I don't work for the government anymore. But it is America's best kept secret. And it became very, very important during the pandemic. And that's actually when I actually left the private sector to go work in government. I joined the U.S. Small Business Administration in March of 2020, helped them launch. Actually, I was still in business school with David over there and started working out of my dorm room. And I helped them launch this program called the Paycheck Protection Program, which was this like $800 billion loan program that, at least at the beginning was giving small businesses about 2.5 months of working capital. We thought that mostly because we thought the pandemic was going to be over.
Yes, we need to give her some.
How many of you have actually gotten like a PPP?
Hey.
Okay. So one of the things that I'm really passionate about is just making sure that this community of Asian American entrepreneurs know about the SBA, know about all the different non-dilutive capital that's administered by the SBA, but also just really good friendly competitive backed loans. So there's just there's actually one program two programs I want to talk about. The first is what's called the Small Business Innovation Research Grant, SBIRS. So this is functionally free money from the government. These are non-dilutive grants that basically support different kind of business areas that's usually aligned with something that the government is interested in. So I've heard robots, medtech, cybersecurity. These are all things that are kind of more aligned to a national agenda around U.S. tech competitiveness, right, and building capacity within the government. And these grants are actually huge. So many of the portfolio companies in my venture fund have received from anywhere from $5 to $30 million of free non-dilutive capital from the government to help accelerate the R&D. you don't actually have to be a US citizen to qualify for these grants. That, I'm here to also just, I think sometimes people think that, but you do need to be running a US company. And it's just, it's something that please call me or reach out after if this is something that you think is relevant to your business. The other thing I want to talk about is a program that, I wish my parents had access to when they were starting their small business 25 years ago, and that's called the 7A program. The 7A program is these government-backed loans, relatively low interest rates. It's like 5 to 7%. No personal guarantees, and you can get up to a $5 million line of credit, and this is just open to anybody. And it's probably the most friendly startup capital for all types of businesses, and one of the things that really surprised me when I was at the SBA was, despite how prevalent entrepreneurship is within the Asian American community, a lot of SBA loans, there's shockingly low utilization amongst this community. The SBA loans haven't always reached minority communities, even though these government programs are actually designed to preference minority communities. There's all these things that a lot of people don't realize, where even working with the government or being a government contractor, you are actually preferenced if you are from an underrepresented community. And so that's actually something I'm now very passionate about, is just raising awareness and improving access to government-backed loans and government-backed programs.
What was the first type again that you're talking about, the grants, the name of it?
The first one, so the free money, the non-dilutive, is called Small Business Innovation Research Grant. So it's just sbir.gov. And then the other one is called the 7A loan.
Thank you.
I didn't know about this one. It's amazing.
I think we need another round of applause for Christine and the PPP, the SBA. Oh, thank you. All right, taking a little bit of a turn here, Ratna, this one's for you. Can you talk a little bit about how business can achieve meaningful success metrics to shareholders, particularly in data-driven sectors like internet and direct-to-consumer companies?
Thank you. I'd almost argue that every sector today is data-driven. If you don't have data, you don't have much. And so success metrics, or more colloquially KPIs, that Christine mentioned, Robin mentioned, is important really in every sector today. In our experience, when we have worked with founders, be it early stage, growth stage, or later stage, we've seen how important these KPIs are, and how important it is to have a robust framework around it, especially when it comes to fundraising and in investors, as you heard from them, and what KPIs they look for. As Christine mentioned, if you're early stage, pre-seed, seed, it's more product market fit, go-to-market fit, what your idea is, where you have, if you're a repeat entrepreneur, all of that is very, very important. And sometimes it's just that,
Sorry.
it's all about storytelling at a very early stage. It's only when you start to move into growth stage, Series A, B, and later, that's when you focus more on the financial metrics, and some things that's more tangible, after you have launched your product, after you have started generating some money. So it's important to have a disclosure strategy or a KPI framework, actually, which is dynamic. It kind of evolve as your business grows, as your market conditions change. So, building that framework, however, early is critical, even if you may not use everything at all at once. So, have your KPI and have a plan, what you plan to do, when you're going to raise your Series A. You may not track it today because, it's too cumbersome. As a founder, as a small team, it's too burdensome to manage and track all these different kind of metrics that you hear people talk about. But you need to have a framework, because often when you've reached a scale, it's very hard, laborious and costly, time and money perspective, to actually pivot and change. So what we tell, and then, as Lee mentioned, you should align your framework, your strategy, based on what your end goal is. What is your North Star? And it's really hard. Today you're focused on getting that next near-term KPI, next deliverable. What am I going to earn in the next 6 months, the next 12 months? But it's really very important to have a clear idea about where you want to end up and plan accordingly. And in my time, honestly, I spend a lot of my time daily talking to founders, executive, and management team. just how to think strategically about their business, in terms of KPIs. What are the metrics you should talk about? How should you craft your narrative? And also help them see what's around the corner. Because we work with so many different stage founders, pre-seed, seed, Series A, B, C, to even, public companies. So we know what's gonna come, oh, you are doing this. I have a client who was doing this 5 years ago, and this is what he faced. So, so we can give that insight, and that's what a big part of my day is. And I've spent almost all my careers with consumer internet companies, and I've actually seen firsthand how valuable and incredible that is when you can actually build that. It builds credibility with your investors, and they come back to support you in round after round, seed, Series A, B, and then IPOs. So I think it's really important to have that early, but just don't take too much pressure in tracking everything early.
Lee, I'll flip that to you, just to share a little bit about some of the best practices that you've learned after founding so many businesses.
Best practices for KPIs?
KPIs, reporting, setting up the framework early on for success.
Okay, so I think to what Ratna was speaking to, the strategy of tracking your finances and planning your finances and financial strategy is extremely important, even from day one, right? So for my company this time around, we hired an outside bookkeeper and fractional CFO basically from day one, right? Just to help us take care of our framework and structure for reporting. And then as a CEO for an early stage company, your job is to figure out what kind of metrics you need to float up to share with prospective investors or clients in some cases, and that does evolve over time. So I think just knowing your numbers is extremely important, right, for all businesses, and it's actually really surprising to me how many business owners I speak to, and I ask them, so how much revenue have you generated in the last year, and they don't know off the top of their head, or they have to hop into QuickBooks and generate a report from there, right? And I think it's really useful to have those high-level metrics as you're also planning out your operations, as you're thinking about what your burn rate is going to be, right? As you're planning future product launches, et cetera, and future spend, make sure you stay on top of your numbers.
Can you define burn rate really quickly?
Burn rate is how much money you're burning every month. Yeah, lighting on fire right now. And that's the standard term, at least for high growth companies, to effectively measure your expenditures, and that's offset by your revenues, right? So that's net income.
Robin. You're like, oh goodness, what is she going to ask next? Changing topics a little bit. For you focus a lot on growth stage companies beyond the A. And so can you talk a little bit about what shifts from an investor expectation from early stage to later stage, and then also what are some of the things that you look for?
I think it shifts quite a bit in terms of how we evaluate companies, especially at like the A and beyond. One, when we look at, I think taking a step back about like venture in general, right? Like we have our own investors that we report to, and so like those are called allocators or LPs, and for us, we have a time horizon for each of the funds, and so most of the time it's somewhere around 10-year cycle for a fund, and so for us, we're looking to invest in companies to build a portfolio across like different stages, and over time we get exits, and those exits are how we return money to our LPs, which then in turn gives us more money to continue investing. I say all this, and why that matters is because when we look at funding into startups, we look at one, what type of company will you be when you exit, right? And that matters a lot, because if you're not looking to sell your company or IPO, like you probably shouldn't be raising venture capital in general, right? Like if you have a lifestyle business or a side hustle, like probably not for you. But in venture, like at each stage, we tend to want to get a specific ownership into a company. And so, most of the time is somewhere between 15 to 20% each round, probably less, the bigger you are, and so maybe like a Series B, Series C, or, taking a 10%, 15% dilution. We look for which category are you in, and we underwrite the company to the type of exit profile that you will be in. So for example, if you're a software company, we look at the comps that you are in, or consumer internet companies. Like if you are a, let's say, e-commerce company, right? We look at the public companies that are in the e-commerce bucket and what they trade at. And so that when you decide to sell your company or IPO, how much money or what valuation you will be worth. And so that matters a lot for us. And so when we evaluate later stage companies, what we look for are like, how are you tracking across those numbers? And a lot of times I think what founders don't get, like when we say no to, or any venture firm says no, it's not always about you. I know that's like kind of cliche, but it's like also what is at the table at any given moment, right? Like right now it's probably a lot of AI, right? Like if you are a commerce company, you're probably a bit out of favor because public markets are not really that interested in those type of companies at the moment. Valuation is very low, and so like the valuation that you're going to get or ability to raise is not going to be that high or inflated compared to fintech, compared to software, compared to AI, or data or cybersecurity. And so I know it's a lot, but it does matter what type of category you're in and like how attractive that is to a VC firm. And a lot of times we're looking at many deals in the pipeline as we evaluate yours. And so that, I feel like right now it's more of a investor's market than a founder's market, unfortunately, right? And so that's when you have to really hunker down to like make your business as efficient as possible, because burn rate is what really matters at this point in time too.
And one thing I want to add is it's not either or, right? So, and actually, Ratna, because you work with late stage companies, I'm sure you see this, like a lot of successful businesses take a variety of capital. And so a lot of times it's actually matching the right type of capital with the stage of your business, right? I really like, Robin, the way you framed it. It's like, you're kind of talking about like the expectations, right, of investors when they're giving you certain types of capital, right? So like when I was at the SBA, it's basically, I was giving out loans, right? So you give out loans with the expectation of getting paid back, right? I think when you're taking venture capital money, then you're sort of taking that money with the expectation of a certain growth rate. And all of that is possible, but I think where I've seen entrepreneurs sometimes where they tend to struggle is maybe taking the wrong type of capital at the wrong stage of their business. I'm just gonna use deep tech as an example, robots, med tech, et cetera. Many of the companies that we evaluate, they might have actually been around for a while, right? Like they might be working on a company that was actually receiving government grants or capital from like a university, right? It was being incubated in a lab, but I'm meeting them when they're choosing to raise venture capital for the first time because the technology has already been developed, it's been proven out, there's some defensibility, right, in the sense that they've gotten some provisional patents, and they're finally at a point where they can take that technology and commercialize it. So when I'm talking about entrepreneur, they tell me that they didn't want to use venture capital to subsidize the development of their technology, but now that they're ready to go to market, that's when they want to take more dilutive funding. So I just want to say that there's a lot of different ways. Like it's not either or, right? And maybe the thing that I'd like everyone to think about, right, is what you anticipate to sort of be like the development of your company and just understanding the different types of capital that can support that growth.
Right, and it similarly kind of ties back to the use of proceeds, right? And what kind of growth you're expecting. So, if you are working capital, please don't raise venture capital for working capital, just take a revolver. But if you're looking to grow really, really rapidly, need a big capital infusion to do that and achieve that, then debt is not your friend because you have to pay it back. And pretty soon, maybe when you don't have the cash flow for it. So you'll be restricted in what you can do. So that's the time, you go raise venture capital because they are fronting you that money with the expectation of that growth and the risk of your investment. So to your Christine's point, it just really matters what you're planning to do with it as well.
And I want to clarify also, like on the use of proceeds for an entrepreneur, as you're thinking about use of proceeds, like to us, what we look for is you do the certain projections that like you have your KPI set, right, and then, like you're projecting forward. It matters for each of the stages how much money that is and what the use of money is for. And so like really being able to break down like, hey, this money is going to get me to break even, or this money is going to get me to like 5 million to 15 million ARR, right? Or like specifically what type of hires, what type of scale this will be, because it also impacts of like how you think your business. And most of the time you should have probably 2 or 3 models based on like what you think that it could be based on how much you should raise. And even on the debt piece, I feel like a lot of our VC-backed portfolio companies are all like usually have debt alongside each financing round. The caveat is when you do take on debt, you have to set aside cash to service the debt. And so there's also, let's say you raise 30 million and then another 20 million of debt or 15 million of debt, like there's also money that like cannot be touched or else you trip up. And so that's actually what we're seeing right now is what's happening.
That's the covenant.
And Lee, you'll be closing out our panel before we turn to the audience for questions.
Sure, and I guess I just want to provide the entrepreneurs side of this story as well. And I guess the story that everyone here has been talking about, like what story are you telling? I think framing how entrepreneurs seek financing is really important, right? So at the end of the day, investors are buying a product from you, the entrepreneur, right? And Robin was saying how it's her job to source deals, source companies through the pipeline and find the right fit for them to invest into. Investors at the end of the day are looking to invest for a return, right? They're trying to buy an investment product of their own, right? Or they're true believers in what you're doing. In that case, right, it's almost like a donation, right? But for a lot of entrepreneurs, when they go out to seek funding, they may feel like they're in not in a position of power, right? They might feel like they need to convince an investor that they're the right fit. But at the end of the day, it's all about how do you frame what you're building in a way that it's very enticing, it's a great product to sell to investors, right? Because they're your customers. They're not your bosses. They're not donors. You need to sell the marketing of your company using your story, using your team, using your products, using your vision and your total addressable market, and package that in a way that really meets what investors are seeking. And that differs based off the type of investors that you're going to. If you're going to an early stage VC like Christine, then you should probably focus on your team and your vision and your total addressable market and traction to date. And then later stage is probably more about your metrics. Right? So, and if you're going to a bank, then there's definitely a lot of KPIs involved and like trying to find the IRR that matches and proving that you can service the debt that you're taking out. Also, another important thing to note is what is the hit rate and the comps for the different types of investors that are going out to seek. If you're going to a bank, your odds of getting a loan, if you have good metrics, are pretty high. If you're going to an early stage VC, for anyone here who's fundraised before for an early stage company, you probably know you need to take 50, 100, 150 meetings before you get to that one yes for your lead investor, right? And so setting your expectations around how long it's going to take, how many no's is it going to take in order to get to a yes is also very important.
That's great. Thank you, everybody. We'll open it up to the floor for questions now. Yes.
So,
Can you tell us your name, your business?
sure. I'm Christopher Trong. I'm the package security guy. Basically, I like your point about how investors are basically looking for a product to buy, but I would like to say that you're also shopping for the investor, because at the end of the day, the investor becomes part of your company, right? So my question to you guys is, what are some red flags, yellow flags, or green flags, all flags of the rainbow, to look for in an investor, presumably the equity investors?
Maybe you take that one?
Great question, and that's the other side of the coin, right? And so, picking the right investor is extremely important, right? And especially if you're giving up equity in your business, if you're giving up some level of control in your business, if you're raising equity capital, if it's preferred capital for a price round, you may be giving up a board seat. You may be giving up certain rights that you may be able to take in your company, such as selling the company. So the first time around, I'll speak to my own personal experience. First time around, I didn't know anything. I didn't know any investors. I closed my first investor through a cold email, and I gave away 10% of my company for too little money. But they ended up being really great investors, so I kind of lucked out in that regard, right? But I've also, in that process of starting the company the first time around, also brought in some, I'd say, subpar investors that weren't aligned with my vision and what I wanted to accomplish. And what that can end up doing is it can drag on some conversations or decisions that need to be made that really shouldn't be dragged on, right? Or it might prevent you from taking actions that could help you grow the company in the right way. Sometimes it's very difficult to suss that out up front, but I've realized that you really need to get to know and effectively date your investor. Like you said, shop around, right? And shop around, find the right investor that you want to marry, because taking an investment is really like that. And if you think about it, right, the type of business that you're building, if it's in high growth, you may be partnered together for 10 years, realistically speaking, right? So you need to really get along with that partner, especially if they're making these major decisions with you.
Yeah, and I would kind of add to that, from the investor standpoint, we don't make an investment in any founder that we meet for the first time, right? We're building a relationship with you for 6 months, 1 year. I mean, back in the day when it was 2021, maybe in 2 weeks, but but those days are gone. And I would say another thing that we do whenever we work with founders is okay, we could be one of 3, 5 term sheets, right? A lot of times founders also have their pick. And what we encourage founders to do is, one, meet the rest of the team, right? We have a platform team, we have a talent team, we have a BD team, we have other people within the firm that will be partners to you, not just the individual investor. And so meeting those people is very important. It's probably a red flag if they don't offer it to you, to be honest, if they have those services. The other piece is talk to other portfolio founders that they have, right? Look at the names that are in their portfolio. We also give a lot of references, right? So if we're investing in a company, typically about 80% of the time we lead deals, and so that means we do take that board seat. And so talk to other portfolio companies of ours that we have board seats to, and what that looks like.
We have time for one more question. Yes.
Hi, my name is Danielle, and I run a business called Rosetta Languages. I'm very interested in growing my business a lot, but I'm sort of agnostic towards whether any of these funding sources might be a good means for me. I'm curious what advice you have for someone who's the sole owner of their business. They don't, I know you guys spoke about team. Does that mean having other owners with you, or just my team of employees could be my team as well? And then, I guess what advice do you have for someone who wants to grow their, scale their business massively, but is, doesn't have a big capital need? It's more I just want to bring on more people on my team, provide more service, and be able to onboard more customers.
Christine, you want to take that one to start? Take any of the facets?
Yeah. I actually think most companies, there are so many great businesses that don't actually need venture capital, right? Because venture capital portfolios, they typically follow what's called the power law, right? Where VCs are making bets, almost assuming that one asset or one company will return the entire fund, and that's not most businesses. And I've seen a lot of really great businesses take on venture capital, and with that they take on venture capital growth expectations, and it leads them down a road that ends up becoming value growing. So and it's weird for me to, like, as you know, I am a venture capitalist, like I am looking for companies with that type of profile, but I'm also, you know, the daughter of small business owners. My parents ran a really successful restaurant business for 10 years. I also worked at a big loan agency called the SBA. And so I've actually just come like with this appreciation, like thank goodness, like we have all these different forms of capital. And I would say, you know, for you, it really depends on the metrics you're trying to hit, right? Your use of proceeds. But in many cases, again, I'm actually just a big fan of like a friendly government-backed loan, like the 7A loans that, you know, has a pretty low interest rate. Like you can get the capital you need to help fund the growth you want, right? But it's designed in a way where, again, I don't know the financials, but if you feel confident that you could repay it, I actually think it's a lot friendlier than other forms of capital.
I would just be really quick. One way to also just check out, like, is venture right for you, is you can look at accelerator programs, right? So for example, Techstars,
YC.
Yeah, YC, et cetera, and like, just look at the application. And so like, if you can answer all those questions in the application and like what they're looking for, then probably venture is more for you. But if not, then like, I feel like it's a good way to kind of like tease out whether or not you are that fit.
One final point, and it applies directly for you as well as everyone else here, is you also have the option of raising money from your customers.
Right.
And that is sometimes a really great way to align interests, because clearly they already get value from you. They can help you grow, and now this way they can participate in your success when they're already buying from you. It's something that's sometimes overlooked, but if your customers are consumers, you could launch a crowdfunding campaign, right, and raise money from consumers that could use your product. If your product is enterprise, you could go talk to your enterprise customer and see if they're interested as well. A lot of enterprise companies have venture arms these days.
Well, thanks everybody. Thank you for coming.